So without further ado, let's dive in. So the objective today is very simple. Three things, right? We have 5 fingers, but I can remember 3 things. Number 1 is, what is machine learning? I'm going to demystify machine learning, because when we think about artificial intelligence, machine learning is a subset of it. We always think this is in the realms of data scientists, programmers, hackers, those guys with their hoods on the head. It's not true. It's something that is quite simple. Anyone who spends a little bit of time is able to grasp the fundamentals of artificial learning as well as machine learning. Number 2, I will talk about how we use machine learning in aggregate. Personally, I do not like black box method, because it's like a magic box and you just put things inside the black box and things happen. You have to understand before you can invest. So we're going to share how we build our machine learning. Number 3, which is most important, is the future, what it means to you as investors, in this backdrop of very turbulent times. So just 3 things. Now, Professor Kishore has so eloquently given us a framework of the challenges and the issues that we face right now, and all the flashpoints as well. And Eric has spoken about the perpetual energy machine. Can't apply in physics and chemistry, but you can apply this in finance. So another thing we should think about is markets actually rotates between growth and value. As you can see from the diagram, the blue section represents periods in which value strategies do better. And you look at the orange section, those are periods in which growth strategies do better. So it rotates between the two. And as you can see from the last 10 years, or so, in fact, more than 10 years, the markets has been going through a growth strategy period, and probably fueled by the tech boom that we see. So just buy your tech stocks, your FANG stock, your Facebook, your Alibaba, your Amazon, and Netflix, and you're going to do pretty well. And the question right now is that, are we reverting back to the value phase? So just for reference, as of July the 1st, Amazon has fallen 40% from the peak, Netflix 70% down, and Bitcoin, which perhaps is representative of the excesses of the tech boom, is down by 70%. So that gives you a perspective of why markets will always rotate between the two, growth and value. So what's the challenge? The challenge is this: is there a way to pick stock regardless of the rotation between growth and value, right? I'm sure those who have just joined us, our Aggregate, right, has always started off as a very strong tenant as a value fund. So do we have to wait for years before the value period kicks in? So can we have the best of both worlds, meaning that value and growth, we will do well in the portfolio? So that's the first challenge. Now, the second challenge is actually us, human beings, our human limitation. Now, a typical stock analyst will look at maybe 10, 15 financial ratio indicators before he makes his stock selection. The thing is, human beings cannot handle too many variables. Now, let me illustrate this. Look at the chart on the right. I'm sure we've done this in chemistry and physics experiment in school, right? You're supposed to plot the line, and we start shifting the variable so that we have the perfect linear and curved line. And we all do that in school. So that's something that we can visualize. But what about 2 variables? 2 variables, you need a 3D chart. Then what about 50 variables? Your mind can't even visualize it, right? So the famous Pharma and French academic paper about investing in small cap stocks and low price to book ratio, that's only 2 variables. But let's challenge ourselves. Is it possible to have, let's be greedy, the sum of all things, right? Everything and the kitchen sink in our analytical model. Can we do that? So, and the answer, and the only answer is, we need machine learning to help us, right? Not because our methodology is wrong, it's because we need the machine to be able to handle all these variables. So, machine learning. which is subset of AI. So what does AI do? We watch too many Hollywood movies in which Skynet, Terminator, and for those who love classic movies, HAL 9000, Space Odyssey 2001. So all these machines will take over the world. But in truth, AI is really good for three things, right? Number one, they learn from the past input, they adjust to new inputs, and more importantly, they perform human-like tasks. They're not godlike machines that take over the world. They replicate what we do, but in a more efficient and faster way. That's it. So where Aggregate is right now is we are at the machine learning level, which is a subset of AI. And in months or even years to come, we will go into deep learning, which is even harder, which is even more accurate in its predictive ability. So AI, what is AI good at? AI is really good at classification. Now, think of a scenario where you tell your child, can you tell the difference between a cat and a dog? And what do? You bring him to the zoo, bring him to the pet store, or show him pictures, right? And the kid get it immediately, one or two pictures. But AI is not so clever. They need tons and tons of sample data to train it to understand the ability to differentiate the cat and the dog. But once they get it very fast. So right now, the technology, we're talking about 97% accuracy if you use AI to differentiate between a cat and a dog. And this is something that we've been doing. AI classification, we've been using AI classification all the time. Think about Facebook, right? Facebook, well, you know, Facebook is about pattern recognition. It knows what you, who are your friends, who are your family, who are the people you want to show off, so that you can show off your every night, your meal is amazing, right? You have Amazon, that actually is a pattern recognition of your purchasing pattern. Tesla, road recognition. So ultimately, pattern recognition is still about classification, which is what AI is about. That's what they're good at. So I think one of the webinar participants asked a very good question. It says, can you show us statistics of how you apply AI to finance? What's the validity, right? So here's a number. This is a shocking number. This is from Forbes. 85% of AI projects fail in the real world. 85%. So whatever you use right now, whatever you see that works, right, is that rare 15%. And if you're talking about specialized projects, specialized areas like finance, it's probably 5 or 10%. So it's a rare breed, right? So you go for tech forum, tech competition, you hear all this AI this, AI that, but AI that work is rare. So that's the 85% project failure rate. And also there's a checklist. It's very important when someone says AI, you have to ask 4 questions. Has the AI been trained? What is the size of the data set? If you just test it for 1 month or 1 year, that is not good enough. And how rigorous is the testing? And ultimately, right, what is outcome? There must be a positive outcome that it can really help you in your daily life. If not, then AI is pointless. So 4 questions. So before embarking on this AI journey with Aggregate, I thought that that's how you apply AI in finance this way. So you put in your stock market data, your market indices, your company financial, the macroeconomics indicators, and the kitchen sink and everything. You just plonk it into this magic machine called AI. And the output is that you can pick the top 10 performing stocks. I think a few questions from the webinar participant asked for that, right? And not only that, you can tell at 4 p.m. next Thursday what's the price of Netflix. This will fail. It's not possible because you're asking the AI to do more than it could, right? Let's look at it this way. These are 3 stocks: Hershey, Duke Energy, and Netflix. Even human beings, just with 6 variables, human beings can't answer this quickly, right? Look at Netflix. Operating income growth is 90%. Obviously, it's a good stock, but now not so good. Maybe I should go into Hershey or Duke Energy because the PE is low. So as human beings, we can't decide quickly, and you want the AI to do this? Another challenge is this. It's a question of time. I know that's the Depeche Mode song, question of time. And if you look at Netflix, right? Yeah, just last last year is the darling of analysts. I love Netflix, and it makes sense because COVID, people stay at home, they watch more stream services, and even if we go back to office, to office or schools, they will continue subscribing to the service. But now we know that good content is hard to produce. There's only so many Queen's Gambit or Umbrella Academy, right? And I'm sure right now you run out of things to watch. And now you hate Netflix because the share price has fallen. So what is the problem here? The problem is actually noise. There is too much noise in financial data. The statistical speak is there is a very low signal to noise ratio, but the layman will just call it too much noise in financial data. Therefore, it's very hard to apply AI in finance. But is there a better way? And this is the aggregate way. We have figured a way out to use machine learning, and let's dive in how we do it. And it's going to looks like a cooking show. We're going to show you like just what Eric did, step 1, step 2, step 3, all right? Okay, so this is how we go about this. This is a 5 steps process. So step number 1, we call this feature engineering. So remember, the AI does what humans do, right? So we feed the same data as what the analyst will require. And just as an indication, we have 50 fundamental indicators, we have 50 technical indicators, and 50 financial journals indicators. Now, financial journal indicators, these are professors, these are researchers who spend decades of their life studying a particular phenomenon. And not to include that wisdom in your engine doesn't make sense. Of course, we should include that. So we are agnostic in that sense. We put all the information in and we see which one works. That's step number 1. Step number 2 is we classify the stocks, right, by good versus bad, cat versus dog, remember? So we split a stock, say 1,000 stocks, into 2 halves, right? So the first half is the 500 stocks, we call them good stocks. We ask the machine learning to pick more here. And below the line, we draw a horizontal line, we call it the median or middle line. Below, we call them bad stocks, and we ask the machine learning, please pick less stocks here. So basically, we have converted a complex problem into something very simple, a classification, cats and dog. I need you to hold that thought. Next thing is we ask the machine to rank all the stocks in descending order from the... So stock A will be the highest probability above the middle line. Stock O, the red, will be the lowest probability above the middle line. So we rank them in this descending order, right? And after this, we will find out each stock return and see if we are able to get a pattern, a consistent pattern. So the next thing is, remember the checklist? We have to test our data. We have to test our machine learning in a very rigorous way. And we do it. We call this the walk forward test. So how does walk forward test do is we train the data from 2007, 2008, 2009, and then we compare it to 2010. And then the next year, we add one more year, 2010, and then we compare it to 2011. It's almost like your 10-year series exam, right? Every year, you do one more year exam and see how well you do. So that is how rigorous our testing is. We call it the walk forward testing, but that's not good enough. We want to test our machine learning to the point of failure, right? So one country, every country has its own characteristic, the stock market characteristic. Not good enough. We want to do it in 16 countries. That is how rigorous our back testing is. So Singapore, China, Hong Kong, Malaysia, so on and so forth, Germany, and we even include STOXX, which is a European index. So we want to test it. And now, step number 5, how do we know that our machine learning actually works, right? So if the actual result of the stock ranked by our machine learning shows a descending curve, it simply means it works. Statistically, we call this a monotonic relationship. I know it sounds like a new tonic. No, monotonic comes from the word monotonous. So it's a curve or straight line. So if you see this line, it shows that our machine learning works. So let's think of, show you an example where it doesn't work. right? So if we see a random pattern, then our machine learning has failed because there's no consistency, right? So this is a non-monotonic relationship where you see a random pattern. And here comes the most important thing, the results. The results is everything. So we have compiled a table. Now, the table is a bit complex, but not to worry, we will plot the charts. So we are looking at a sample of 10 countries. We have 16 countries, but it's too much data. So we just take a sample of 10 countries. These are actual average 1-year return from 2008 to 2021. So that's about 13 years. So we break down the universe of stocks per country into 10 baskets. That's why I call it decile. Decile is just 10% of the universe of stocks per country. And then we calculate the grand total return for that 10% versus the average country return, which is at the bottom, right? Now, the thing is that this is what we see, right? When you plot the chart, when you see this, you must be convinced. The only conclusion is that our machine learning works because you see a monotonic relation in all the 10 countries and region. And it's not a perfect line. If it's a perfect line, I'll be worried. That means there's something wrong with our model. It's too perfect. But you see a consistent descending curve in all the markets. And it's beyond a reasonable doubt that our machine learning works. We are in that rare 5-10% of machine learning projects that works in the world. And in fact, when I saw this, when Eric showed this to me, I was like, yeah, it was an open mouth, jaw drop moment. I said, you know what, I have to work for Aggregate. Now, same table, but now we look at the top 10%, which is called decile 1, and then we look at the average return of each market, and then we do a comparison. So as you can see from this table, if you have put money in decile 1, which is the top 10% above the middle line, remember, these are the high probability stocks, you get 11.7%. The market, if you just put all your money in all the markets, right, you'll get 5.6%. So you have an outperformance of 6.1%, a delta of 6.1%. Now, the thing is that it's very important to understand the limitation. The caveats is that if the market is down by 10%, even if you outperform by 6%, it's still -4. So there's no magic bullet here. There's no magic tree here or fairy tale here, right? But the thing is that over time, we can deliver these results quite confidently. Now, what in every PowerPoint, there's always one slide that's most important. Now, this is the most important slide, right? Our biggest discovery, right? And thanks to the pioneering work of Eric, David, and Jimmy and the rest of the team, we found out that there are certain indicators that can cause stock prices to move. This is a 200-year-old puzzle. Why 200 years? Because the US stock market was founded, what, 230 years ago. So every textbook is always wondering what causes share price to go up. And we found it, right? So if you look at the chart on the right, this is a heat chart. So the dark blue section are those indicators that are impactful to stock prices. And then below, those are indicators that are not so important. So we found out, with the permission of Eric, I'm going to share a bit of proprietary information here. We found out that research and development expenses divided by market capital, that means your R&D spending, is a very important component in deciding share price movement. Then you say, oh, that's easy, that's Captain Obvious. If you spend more money in R&D, more innovation, more new products, and higher revenue, and better profitability, right? That's Captain Obvious, nothing new. This is not what we found out. We found out that if you combine research and development expenses to two other indicators, we call the cluster functionalities, this will impact how share price goes up. So we know it's amazing when we found this. And this is not the only cluster. There are multiple clusters that we found that actually cause prices to move. So this is our biggest discovery. Without hyperbole, this is something like, it's almost like Santa Claus tuck his a sledge on top of your roof, and you have endless treasure of information. So What do we do with all this information? Again, Captain Obvious. Instead of buying the top 10%, just buy the top 1% of the highest probability above the line. So say the US stock market has 3,000 stocks. So 1% is 30 stocks. And then what Eric says, you diversify in 10 or maximum 20 countries. So just repeat this strategy, buy the top 1% in each country's stock market, and repeat this in 10, 20 countries. That's it. It's not too complicated, but the mathematics, the science behind this, well, that's difficult. So let's talk about why are we unique. So now you understand the uniqueness, secret sauce of our machine learning algorithm is that by asking our machine learning to pick group A, the highest probability above the middle line, we inadvertently or indirectly succeed in picking the best performing stocks, and yet making the machine learning do what it does best: classification, dog and cat, right? Now, however, there's no magic crystal ball or there's no fairy tale here. We still need time and diversification for this to play out, but we are confident that over time, we will win. So let's talk about the future, what it means to you as investors. So the question investor always ask is, what if the entire global market undergoes cataclysmic changes? As Professor Kishore has already painted, the world is turbulent enough. There's the Ukraine war, there's Taiwan-China flashpoint, there's US stagflation, there's tech stock bloodbath, there's DeFi revolution. I still remember Thomas Friedman used to say, this McDonald theory: if country A has McDonald, country B has McDonald, A and B will not fight. But now we know they do, right? Russia and Ukraine. DeFi revolution, buy cryptocurrencies, and you don't have to buy stocks. Why buy stocks? Crypto is the future, right? And it's a best defensive asset, if you can call that asset. And it didn't work out that way. When the stock market fell, so did cryptocurrency. So the fair question to ask is, can any human being, any human analyst do better? The answer is probably not, right? And another thing, important tenet in Aggregate is that our biggest safety net is still diversification. Diversification, diversification, and diversification. And our AI will learn to adjust and recognize the new pattern very quickly. Another question asked by participants, this question always comes almost 100%, is like, the elephant in the room is, what works in the past may not work in the future, right? But let's not forget that our investment methodology, the tenets, the philosophy in Aggregate has not changed. The AI merely does the same task, except that the human analyst cannot handle 150 variables, while machine learning can. And our fund managers will filter out the stocks. There's a human layer that are deemed high risk out of the portfolio. So they don't wake up in the morning and this Terminator generate 20 stocks, and our analysts will just buy the 20, our fund managers just buy the 20 stocks blindly. There is a human input involved. And last but not least, diversification has not been abandoned. There is very little over concentration risk in Aggregate. It's very much reduced. So even if there's a black swan event, remember, we are diversified in 13 countries currently, and there'll be more, and therefore we are safe. So that is the summary of this. My session is this. Number one, machine learning is an enhancement and not a replacement of our investment strategy. Number two, we actually know the clusters of indicators that will drive stock prices up or down. And number three, we are doing this continually to improve our model, our analytical abilities. So I quote here Robert Frost's "Miles to go before I sleep." I know my colleagues, they hardly sleep. And this is, of course, for our investors. And this is really the time to seek investment, not to run in fear. And think about this. This is what this webinar is about today: managing global uncertainties, seizing global opportunities. So this is the time not to run away, but go for it. And that's it. Thank you so much.